Welcome to TMS Insights. It's a different one at a different time for all of us, and it's obviously mid-June, Ben, and I'm on the other side of the world on holidays at the moment in the Europe, just having some time with family. And but we thought it was really important to get a message out to clients because there's been an incredible amount of volatility and a large amount of selling in the market, which we understand at times can be confusing, but is part of the normal grist of a market. Ben, look, just maybe before today's sell-off, just giving people a bit of a flavour of, the continuing drivers of this changing interest rate environment and how it impacts on equities.
Yeah, and good to see you, Jeremy. I'm glad you're looking relaxed. It's a continuation of the same theme that we have seen for all of this year, where the paramount concern amongst equity markets has been inflation. We know that inflation cropped up as a result of the COVID lockdowns and the reopenings out of it and all the knock-on issues of COVID. We then saw the Russian invasion of Ukraine, which in hindsight, I think, poured petrol over a small fire and has created much bigger issues. And on top of that, of course, we've had the China lockdowns and unfortunately Shanghai and Beijing have gone back into lockdown as of this weekend. But there was a growing view in the market that these inflationary pressures, particularly in the US, were passing and potentially had peaked. And, what we unfortunately saw on Friday night was an inflation print that was well ahead of market expectations. And that was not a pleasant surprise. And really what that now does is it ratchets up more pressure on central banks to lift interest rates even faster. And we've again seen this, pressure in bond yields, which we've been talking about for a year now. With the Australian 10-year now, it's just under 4% today. So, we've seen a significantly higher interest rate environment we're moving into.
Just before we move on to what it all means, just to explain why, because I think it's really important why markets change so violently on these things. And just to expand on that comment about the CPI print in the US on Friday night. So it came out at 8.6 for the May month. They do it every month in the US. The previous 2 months were 8.5 for March. And then it went down to 8.3 for April. And so that gave people in the markets some comfort that actually inflation might have peaked. And then when it came out for 8.6, above the high of March, last on Friday for the May period, it scared the markets, like you said, Ben. So, and now everybody can see the rates have got to go further and faster. So violently, it impacts immediately on all asset classes, Ben, but the one that happens most are bonds. As you mentioned, the 10-year bond up near 4% in Australia, which is really a big move for where it's been. So they move the fastest. Then equities are really quick out of the gates. So we've seen a lot of repricing, which is the selling down there. And if people understand, it's because expectations. It's the movement from what somebody was expecting to what it became, and that's the real story there.
Yeah, and I think where we go from here in terms of concerns or expectations are the knock-on effect that this will have on the economy, and that's probably what's getting the growing concern is that central banks will be forced to hike and hike hard. And really, the main ammunition that they have to fight inflation is to try and reduce demand. And to reduce demand, they need to try and not scare, but they almost need to shock the consumer into slowing down this crazy spending behaviour that we've seen coming out of COVID. They need to try
and spending on some good things, but at really high prices, such as cars, property,
travel,
and a lot of travel.
Yeah. Shelter,
so,
has been one of the biggest contributors to US CPI is rent and dwelling prices, renovation and building activity. Of course, we've all seen this in our everyday lives is people have been willing to continue to spend. And, by going forward, that the hope that we have is that the central banks can get on top of inflation without causing too much damage to the underlying economy. And that's going to be that, they're calling it threading a fine needle, trying to get that balance right. And it might even, as crazy as it sounds, it might even see interest rates start to fall in another 12 to 18 months from where we are now.
Yeah, and because it's necessary to just kill off as much of this inflation as possible, the remedy, the medicine has to be fast and pretty aggressive to do exactly what you're saying. And I like the term shock the consumer, shock the lack of checks and balances on spending. It has to be reined in overall, and so that's going to happen. Now, Ben, property, it takes longer to impact on property, but this has got you mentioned it's going to impact on the economy. Property as an asset class has to be affected by that, even if it doesn't happen as quickly as equities.
Yeah, look, and I think the $1 million question is how big an impact does it have, and that will come back to, again, I'd say there's a lot of debate, and there has been a lot of debate for the last 6 months about whether the bond market has been too aggressive. We saw Matt Comyn, the CEO of CommBank, come out and say we just cannot see rates going up the magnitude of what the bond market is suggesting. But we have seen another leg higher by the bond market. So I think there is no doubt that we are going to see quite a significant change in the variable rate. We know that a lot of Australians fix their mortgages at sub 2% interest rates, a year or two ago for 3 years. Those mortgages are going to shortly roll off onto much higher interest rates. This is all part of what the RBA is now trying to achieve. It's trying to reduce our spending, which will take out demand, which will see prices start to normalise and get on top of inflation. But, in terms of how big the impact is on property, there will be an impact. How big it is, there's, as with shares, there's always the doomsayers out there. There's always the eternal optimists, and it'll probably be something in between.
And these are normal things, for the property market to pause or do that. Having run up as hard as it did last calendar year, it's more likely to give up some ground. Equities, this is a normal thing. The interest rate cycle to turn, these are things that do actually happen. We've had a really one-directional interest rate market for a long, long time. So it's a new sort of shock to a generation, but it is something that is part of the cycle, and we've lived through it. Before we get on to how it's all going to impact on equities, I want to discuss crypto for a sec, because it's relatively new asset class, if that's what it is, but it's having an impact on other asset classes. So we understand that the net value of all cryptocurrencies was circa $3 trillion at the end of last year. $2 trillion of that has been wiped off. It's been the most affected in the part of the investment world. That $2 trillion doesn't now exist in the balance sheets of individuals, and it will have an impact on the real economy.
Yeah, absolutely. I mean, I remember Hamish Douglas from Magellan saying, crypto was the biggest Ponzi scheme in the history of mankind, and that's looking increasingly potentially correct. This has had to have had a knock-on effect onto the share market. It's impossible to quantify how big that flow-on effect has been, but I can guarantee you that we know that a lot of the coin exchanges across the world allowed you to borrow money against your crypto and invest it into shares. And, I'm sure we've seen a lot of margin calls. Over the weekend, we saw one of the bigger exchanges froze redemptions on its securities. So, it's unfortunate because, I think for most clients, they'd see that as frustrating that they avoided that potentially wisely. And we're getting some ramifications of it now. But it's also important to remember that what we own as investments have real fundamentals behind them. They have earnings per share. They have dividends. They have assets. They, in nearly all cases, are growing. And although they are going through a repricing event at the moment, it won't last forever. Ultimately, the market over time will get this right. And we are going through, at the moment, an incredibly aggressive change in the outlook for interest rates. And the market is still, I think, digesting that and pricing it. But the businesses that will come through this and probably actually thrive in the new environment are the things that we own. So it's, as opposed to owning things which potentially have a value of zero, we know that the investments we've got in time will perform, but they do go through periods like this, like you said, Jez.
I think this is the important thing for everybody to understand. The share market is not one homogenous, singular creation that exists and moves in the same direction all the time. There are parts that will thrive enormously, and when we own these very investment-grade assets. But there is a role in the share market for speculation. That's not the part that we're playing in. That is the part which gets hit enormously at these times. And some of the newer things that are crypto-related, or some of the buy now, pay later space, which is a new sort of area of the finance market that took, by storm through 18, 19 and into 2021, and really getting ripped apart now. And these are things that don't have all the merits of high quality investments that we look for our clients. And the things that are really high quality that will pay dividends this year, next year and beyond, and grow those dividends, are also things that can get sold off at the moment. And so we don't want to confuse what are really high quality companies that are going to perform well and do well in time in spite of this sort of period with the other end of the market, which is for speculation. And speculation is a bad place to be at the moment. It's where it's real pain, and it could be permanent. And whereas what we're seeing now is very temporary in high quality shares, and they've got to find their way. And what our challenge always is to find at these times better quality shares to be always in the higher part of the market. And if that's the to-do part here for people, and it is not just significant to watch all these events unfold without any action. We want to end up with a better portfolio, and there are stocks which we thought were good a couple of years ago that we need to replace with something better, or to change the weightings to something more, concrete and stronger. And these are the reasons why we want you to get in touch with us as a team at TMS and your advisors, so that if you need to have that discussion, then we're there for you. But then also to talk about how this has impact on interest rates. And one area of the market where you mentioned about short-term and long-term rates going up, interest rate securities are a very good part of an investment portfolio that now look even more attractive.
Yeah, and I think this is just one last message we might get across to everyone is that for the last 3 years, if you weren't in the share market or you didn't want to take on too much risk, your alternative return was effectively zero, because that's where interest rates were priced. Now, we have seen a very rapid repricing of rates, as we've discussed. And if you look at the interest rate security area of our market, in investment grade businesses offering debt securities at fairly short tenor, floating rate securities, so capturing the upside of any future interest rate rises, it is now very achievable to get a 6 to 6.5% return from a basket of these securities over a 2 to 3 year sort of period, which that's probably been conservative. If bond markets are right, the returns will actually be even better than that, but that's using a conservative interest rate assumption. So one message I'd get across to clients is, if the moves are making you feel uncomfortable, there is an alternative. You don't have to be all in the market now to generate a solid return. You can always reduce slightly down your growth exposure and now get something which is close to as good. And B, if you're looking for an alternative to cash, which hasn't been there for some time now, there now really is an alternative, which is sort of highly attractive. So there is a silver lining to this. Most clients would have exposure to debt securities as part of a well-rounded portfolio, and that part has been an anchor around their returns for the last couple of years. Going forward, it's going to be a lot more attractive. Just as we've seen, the growth side has come off, there will be some pickup from the debt side.
Definitely. And don't confuse everybody for what high quality shares can do. It's a very good point you made, Ben, that you now have a substitute for a zero rate cash environment. Absolutely. But that isn't getting rid of your really high quality stocks, because they're going to actually perform really quite well. Our expected performance from good quality stocks at the moment from this point is good. The returns will be pretty handy over time, we believe. So let's see how it trades the next little while. It's tough. It's not easy. We don't love the volatility at all. It makes it very challenging for us, but it is a normal part of the cycle. It's been a bit more pronounced of late, but we can ride this through and understand those key points we've touched on today, and anything else, just back in touch with your advisor and contact TMS. We're here to make sure that you understand and we support you in that process. So thanks to everybody for listening, and we'll bring you an update in July, and enjoy the rest of the month.